exam 3. Let me just do a pause here for a second. Okay, so I'm back. Let me bring up Excel again. And we'll go over some of these questions. Okay, so I think the first one I saw here was number 95, the gross margin ratio. Okay. This one's more of a word problem, right? So nothing to work out except for just in your mind. The gross margin ratio. Okay, so let's just put this in context, all right? What is the gross margin ratio? You have revenue, you have cost of goods sold, and you have your gross margin, right? So in this case, if we work it out, just conceptually, if I have $100 and let's say $60 is cost of goods, then my gross margin is the $100 minus the 60, right? So my ratio is going to be the 40 divided by the 100, right? So that's going to be a 0.4 or 40%, however you look at this, right? Or 40%. Okay, one of these you see there is a 0.4 or usually as a percentage. Now, when I think of it that way and I go over these these options, right? See if I can get this in a decent place. Is also called the net profit ratio. Well, it's not net profit because it's gross. Net would be then you take your expenses and you have a net income. Okay, so if I had expenses, let's say of 20, then my net income is going to be the gross margin minus the 20, and my net income percent, okay, or ratio, whatever you want to call it, margin, is the 20 divided by the 100. Okay, so that's a 0.2 or 20%. Okay, so it's not the net income, definitely gross margin. So that one's a no. Indicates the percent of net sales remaining after covering the cost of goods sold. Okay, this is what's remaining from revenue or net sales after you cover cost of goods sold. So yes, this would be an option. Well, we know this is the option, but let's just go through this. This could be an option as you're going through it. It is also called the profit margin. Unlikely, because usually profit margin refers to net profit. And so I would say no on this. You could argue, if you're thinking through this, that this is, no, you still couldn't, because it's just a gross margin, not a gross profit. Is a measure of liquidity and should exceed 2.0. Well, no, this is not a measure of liquidity. This is a measure of profitability. So liquidity would be no. Should be greater than 1 for merchandising companies. Well, you can't really have something greater than 1. You can either have something equal to 1 if you have no cost of goods sold, which is unlikely, but it would always be below 1 because you're always going to have to cover some level of cost of goods in order to get a margin. I mean, your margin could be 99, right? It could be 99%. It could be 100%, but it's not going to be greater than 1. It's always going to be less than 1. So in this case, all of these options are no, except for the second option. Okay. Let's go to the next one. Let's see where we're at. So 95 was the first one. I think the next one I saw was 104, 46.6%. Oh, wow. Which of the following is not included in the cost of merchandise inventory? Okay, merchandise inventory. So usually, let's go back to trusted little thing. What is included in there? Well, your actual cost of merchandise inventory. So assuming we didn't see this, let's just think through what is in here, okay? So it's the cost of the material, let's say. That's definitely in there. You have any discounts or purchase discounts that, remember, this is all sell side because sell side, because this is an inventory item, your cost of inventory. This is buy side, buy side, buy side, sell side doesn't really matter. Let's see, because if I sell it, let's try. Let's see. Let's just maybe look at this on both sides. Sell side, if I'm selling it, I would have purchased it. So it's all the same thing in the end. Let's just ignore that for a second. Cost of purchase discounts, you're going to have allowances, you're going to have returns in here because it's going to reduce the inventory amount. You're going to have any spoilage, which is going to reduce the amount. What would increase the amount? Your cost of transit is going to increase the amount. What else are you going to have in here? Spoilage, theft is going to decrease the amount. Freight, that was freight. Freight in. Not freight out though, right? So if you're selling it, the cost that the shipping cost that the buyer pays isn't in there. Just the cost that you pay to purchase it and bring it to you. So let's see if any of these items are on here. Okay. So discounts is there. Returns and allowances is there. Freight cost paid by the buyer, right? So freight in is a buyer issue. Freight cost freight cost paid by the seller is no, because that's something the seller pays for. It's on the sale side. It's on the actual net revenue side. It won't be a cost of inventory. And then purchase price of the inventory, which is the cost of the material. All right, so a little different wording, but same concept. All right, so this one would be a no. Freight cost paid by the seller is not included in the cost of inventory. All right, let's look at the other ones here. Actually, I wanted to do 113 right there. Oh, I didn't want to do that. Well, this was on the other. Yeah, I have two sections I'm looking at. I think I'll go ahead and work through this one. A company purchased, close this up right here, don't know the values. Okay. Company purchased $3,500 worth of material. Let's put this purchase, 3,500. Transportation cost for an additional 310. Right. And 310. The company returned, I'll start to do adds and subtracts here. The company returned $240 worth of merchandise. Turn minus 240. And then paid the invoice with a 2% cash discount. So the discount is going to be on this plus this times what, 0.02. Okay. The cost of this merchandise is total equals sum, and we'll look at this. Should be that. Pay the invoice with a 2% cash discount. I bought that much and I returned 240. So that's what I'm paying the discount on. I'm not paying it on the freight because that's my cost. Unless they're looking at the net cost after transportation. Now that might be a little bit of a dilemma, but let's look at this first and then we'll see if I got it right or wrong. Okay, 36, 35, 20. Let's see where we're at. 36, 35, 20. I don't see it here, right? So question is, how am I wrong? Great minus, oh, look at that. I messed up on the discount. I even just looking at it just here, looking at through the numbers, this should be a negative, right? Minus, this discount should be a minus, and there we go, 35,048. So I didn't know, I didn't get the problem right off the hand because I incorrectly calculated the discount because I didn't use a negative instead of I used a positive instead of a negative for the discount value. So when I summed it all together, it didn't add up right. And when it didn't add up right, it didn't have the right value over here. And so then all I have to do is double check my values over here, what was being included. And I noticed that there was the discount was negative. Okay. But that's how you come up with the value. All right. So let's look at the next one being, let's look at 95. We've done 95, we've done 113, right? Is that what we just did? We did 95. We did gross margin 95. We did 104, right? Yeah, 104. We did 113. Okay. So let's try, there's another 95 down here that both sections missed. This right here. Okay, the inventory costing method that best matches current costs with current revenues is, ooh, okay. Huh. I'm not sure if I can actually demonstrate this. Current costs with current revenues. Okay, maybe if I just have to work this out, like in terms of inventory views. So if I buy something 3, 1, let's say 23, right? If I buy something, say 5 units at 60 bucks, then my inventory today is times that. Okay. And then let's say on 3, 2, it's $5 and I buy it at $65, right? And let's say 3, 3, another 5 at 70. Copy, and we'll just do this a couple times. And then let's just one more, another 5, but let's make this $55. Okay. Now, when your current revenue, 3, 4, your current revenue, let's say then I sell, so I'm gonna sell, say, I don't know, 5 units. I sell 5 units on whatever day. This is the purchases, and this is the sales. Let's do a sale. Oops. 5 units, and let's say I sell them for $100. Okay. Times that on 5, 5. Okay. So the question is, which one best matches current cost, right? So May 5th, or yeah, this is called May 5th. This is the most current sale, right? So this is the $500 in sale. The most current, if I were doing specific method, is I would have to identify, okay, which of these 5 were done. Well, I don't know out of these all 4 different options. Well, more than likely, it's something that's, let's say it's on the floor, right? And so let's say it was specific method, which is this one. Okay, this batch right here is what I sold. Well, this isn't the most current price because the most current price is 55 and I bought it at 65. So the reality is no, specific method doesn't always match your current cost. It could if it happened to be this one, but that's a probability issue. It's not 100%, right? So no, it's unlikely to result in matching the current cost. FIFO would be this one, right? We would start at the first and we work our way down. So the current cost would not be this one because current cost is 55. And more than likely, you know, my scenario is a little off. Maybe this is more like 75, right? Because costs usually increase, they don't usually decrease. So let's say that even if in this case it's 75 is going to be the current cost and FIFO is going to pick up 60. So FIFO would be no. LIFO is going to pick up the last batch, last in, first out. So the 75 is going to be the closest, most current value that we've purchased. And so that is most likely, okay? I wouldn't always say it is the absolute number, but it is most likely to be the current cost because it's the last cost that we just bought something at. And the reason why I say most likely is because let's say the current cost is $80 and on May 5th, but we haven't purchased anything, right? Since we didn't purchase it, it's not really it may be the current market value, but it's not the current cost. It's not the current value that you have in inventory. That's why I indicated that it's most likely. But in terms of inventory cost, it is the current cost. Weighted average. Okay, so your weighted average. Weighted average. Your weighted average is going to be, we're going to sum these, right? And we're going to sum these. And we're going to do the division plus that divided by this. This is your average weighted. It's called the weighted average. Okay. 6750. No, 6750 is not 75. So that is not the method. And then the net method, whoever talked about a net method in our discussions, it's always specific FIFO, LIFO, or weighted average. So that would be a no. So the reality is you could have possibly done this if it told you that it was the latest item that was purchased, but it didn't. And so the probability of this being correct is very, very low. Therefore, LIFO is always really going to be the most current cost that matches your current revenue. Okay. So did I just hide that? I did. Okay, so I did 95, this other one. And let's do one more. Looks like, let's try, there's a couple in here that are really low. Let's see if there's any others that are super low. I had 109. There's 109 up here. There it is. 109 is 40%. I think 148 was the next one. That's 33%. We might do that one instead. 148, 33%. And then I already did 95. 43 was the other one, was 45%. Okay, so we'll do these two, 109 and 148. That gives you 1, 2, 3, 4, 5, 6. Okay, 109, where are you? 109 is right here. Let's move this up. And let's bring in this. Let's cover up the answer. Okay. Now that we're set, a company purchased $1,800 of merchandise on 1/5. So let's go. Just go ahead and start adding this in here. Purchase was 1,800. Let's do this 7.5. Okay. 210. So 2%. 2%. Oh my goodness. If paid in 10 days, or net if paid in 30 days. I'm just writing it out so you can see how that looks. On July 7th, so 7/7, they returned. So this looks like another one of those things, minus 200. On July 28th, 7/28, it paid the full amount due. No discount. Okay. Assuming the company uses a perpetual inventory system and records purchases using the gross method, the current journal entry to record the purchase on July 5th is to record the purchase on July 5th. That kind of seems strange. Seems like it would be saying the sale. So the purchase was $1,800. That's pretty straightforward. On July 5th. It's an $1,800 deal. What am I doing here? Oh, okay. They're looking for, so they gave me all this information. I started working it out as if I needed to figure something out and I didn't. Okay, classic, Lewis. Okay, what's the journal entry for this first one? That's really the answer to the question. I should have just read the whole thing. And then the correct journal entry to record the purchase on July 5th. That's all I needed to know. All right. Let's see, date, account, debit, credit. Okay, date is 7/5. Whoops, 7/5. The purchase, merchandise inventory, and we got because it's going to accounts payable first and then cash second, it's going to be a debit of 1,800 and a credit of 1,800 to accounts payable because it's a liability. So let's see what we got here. Merchandise inventory 1,600. No, because remember it's July 5th, not July 7th. That would be the amount that's in inventory, not the original journal entry. Merchandise inventory for 1,800. Okay, that's a possibility. A credit for accounts payable. Yes, that's a possibility. That's what we have. Debit merchandise inventory for 1,800. Possibility, but remember, this is July 5th, not July 7th. Big trick here. That's why they give you all this information. I started working it out as if I needed to do something for, the ending inventory or something like that. But no, this is the record the purchase on July 5th. Remember, I staggered there for a second. And why is there we go. Okay, so this is a no. Debit accounts payable and credit merchandise. No, because we know that debit is merchandise. It's an asset. And liability is the accounts payable. So that's a no. Debit accounts payable, no. Once again, anything debit accounts payable is an absolute no. So we know these ones are wrong, and we know these two are wrong because they include the return. So the only thing that's right is this second one. Okie doke. That one was tricky. Okay, that was 109, right? And then 148, I think, is the other one that was, yeah, this one right here. Okay, let's put this up here. Oh, come on, work with me. 148. Okay, let's read the whole thing this time. I don't want to see which one is which. Okay. Cushman Company had $800,000 in sales, sales discounts of 1,200, sales and returns of 18, cost of goods sold of 380, and operating expenses of 275. Gross profit. That's a great word, gross profit. I'm not sure why they use gross profit sometimes, gross margin another, but there is a difference, but they use them synonymously. All right. So sales is $800,000. Let's make sure I can see what is what. Okay. Discounts. Sales discounts is $12,000. Sales, returns, and allowances is $18,000. And you're wondering to yourself, Brother Lewis, why don't you put negatives on here? It's a great question. Let's move this over here so we can do a little, subtotal for grins. Total discounts, returns, and allowances. We're just going to equal the sum. I just want to see if they ask anything like this. And then the net sales number is going to be that minus those. Okay. Cost of goods sold is 380. COGS is 380. So my gross margin, or how they're calling it, profit, is the net sales minus this. Now, theoretically, I could just stop here, but I'm just going to go ahead and do a full P&L for you. So you have expenses of 275. So our net profit, net income, sometimes they call it profit, is the 390 minus the 275. Okay, with that in mind, now let's look at where our options. It says gross profit equals. Okay, so this should be our number. Let's see what they're looking for. Okay, 770 ends up being your net sales. So no, that's not profit. 115 is your net income. No, that's your net income. It's not gross margin or gross profit. 390 is 402, not on my list. 408, not on my list. So these are absolute no's. These are distractors, and this is the actual number. Okay, and they show you here. Oops, how they got to their number. The 800 minus the discounts and returns minus the cost of goods sold to get to the gross margin or gross profit. Okay. I think that is it. I got a little time. Maybe I'll throw in one more just for grins. Let's look at which one. Just for grins. Okay. Looks like I got 4-3. Let me hide this. 4-3 or 4-11. Now 4-12 was one that the other class got wrong. So let's look at this one. Actually, let's look at 4-12. But it's just closing entries. Let's see. Well, let's look at the title of these. 4-3 is merchandise accounts and computations. Okay. 4-11 is accounting for shrinkage in a perpetual system. And 4-12 is closing entries. Okay, so I'm not going to do that one. Accounting for shrinkage. Yeah, that's helpful. Probably, or merchandise accounts computations. Trying to think of what might be on the final exam. So let's think, I don't think shrinkage is probably going to come up. So this is, and plus you got 45 out of this one. So let's do this one. Okay. So let's see what we got here. Okay. Where are we at? Let's use the following information in random order from a merchandise company and from a service company. Oh, brilliant. Compute the cost of goods available for sale, cost of goods sold, and gross margin or gross profit for the merchandiser. Okay, merchandising company. Okay, so goods available for sale, cost of goods sold, and gross profit. All right, let's take this and see what we need. Oh, I don't like it that way. Base values. Okay, so what do we need? Well, they want available cost of goods available for sale. Let's do this one at a time. Okay, so that's going to be your let's just work through. We got beginning inventory of 1,300. We would have purchases. We would have sales. No, this is available for sale. Let's see, purchases. Let's see, ending inventory. We have to do this backwards. Okay, so our purchases, net purchases 16,700, ending inventory is 7,800. So now we're going to do our math. So we're going to take the beginning inventory plus purchases minus ending inventory. This should be what's available for sale. Cost of goods sold should be the same, assuming that that's, yeah. God. Net sales. This is not, we're not going to use this number. This is an X. That's not necessary. Beginning inventory, goods available for sale. Beginning inventory, cost of goods sold, and gross profit. Let's think of the other one. Revenue. Let's see, net sales, COGS, gross profit. So on this one, we're going to take the 25,500 and we're going to minus what I think is this COGS bit, 21,900 plus that minus this. Okay, so that's 3,600 for gross profit. So the question is, goods available for sale. I think they're the same number as the cost of goods. Beginning. Oh, okay. Available for sale. Now you got to remember, sometimes I don't understand their terminology any more than you do, but I'm making an inference of what's available for sale is your beginning inventory plus your purchases. That should be your available for sale. The difference between all this calculation here that I did was the cost of goods sold, because you have an ending inventory number, which would be, beginning plus purchases minus inventory gives you what definitely had to have been sold, what was sent out, assuming there's no discounts or whatever returns. So I think these are my values. Okay, so that should be cost of goods sold, that should be available for sale, and this should be gross profit of the merchandiser, right? And then compute the net income for each company. So on this one, then I would also, on the merchandiser, I would have my expenses of 2250 for a net income of 36 minus that. So this should be the other number for B. Okay, and so this is for this one. Let's just pick this off for the other company. Let's see if we can figure this out. Value. Okay, expenses revenues. Don't need this. Prepaid rent, accounts payable, equipment. This is all irrelevant because these are all asset accounts, or this is an asset account, accounts payable is a liability account, and the equipment is an asset account. So all this is irrelevant. All you need to focus on is revenues and expenses. And in that case, you have rev and news, and you have expenses, just straight up. All they're telling you is that revenues is $30,000. I think merchandising, cash. Yeah, I can't see how this could be anything different. So we'll see what goes on here if I'm wrong. Plus that minus that. So this should be the other number. Because it really doesn't tell me. Oh, this is a service company. Yeah, it doesn't tell me anything about labor expenses or anything like that. Okay, let's see how we did. All right, let's move this back up. Okay, and there we go. Goods available for sale, 29.7. Cost of goods sold, 21.9. Gross profit, 36. Net income for Krug service, which is this one, is 21,000. Net income for McNeil Merchandising Company, 13.5. Woohoo! All right. That took me a little bit. Took me what, 8 minutes to figure out these two problems. But with a little bit of triage, I was able to figure it out. So that's how I would have done it. And I promise I did not cheat. Okay. Anything, I think those are it. What was that? What did I do? I did the 45%er. That was 4.3. Okay, so I hope that helps out. If you have any other questions, either on the exam or any of the material going over now, please just let me know. Take care. Bye.